You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this edition of the Systematic Investor Series with Katie Kaminsky, Jem Kazan, Rob Carver, Mark Resumsinski, Richard Brennan, Alan Dunn, Nick Bolters, Andrew Beer, and I, Niels Kaastrup-Larsen. As you can tell from this introduction, today and next week will be very special episodes because it's the first time that all 9 of us are together for one big conversation and debate. So firstly, let me just say a big thanks to all of you for making the time for this extended recording, which I really have been looking forward to. We are recording on December 14th, and this conversation will be split into 2 parts and published on December 23rd and December 30th. We got a great lineup of topics for our listeners over the next 2 episodes, and let me just mention a few of the themes that we're going to be covering today and next week. We'll be talking about 2023's performance and the outlook for trend and volatility into 2024. We're going to be talking about the shifting market microstructure and the impact of zero-day options, as well as the Fed pause, as well as other things. We're going to be discussing classification. Are we using the right names for trend following volatility? Should it be classic trend or quant systematic? We'll debate this. We're going to be discussing backtesting and rebalancing, how to deal with this. We're also going to be diving into non-trend strategies. Are they worth your time and your money? How much diversification is really needed? We're going to be debating research, whether it can stand still and how does AI fit in. And of course, I'm sure we're going to be talking about whether to replicate or not to replicate. So as you can tell, we really have a packed agenda. So let's just dive into it right now. Now, the format for our year-end conversation will be that we will pick what we think are the best and most relevant topics from a long list of ideas and that we shared with each other beforehand. And generally, as we always do on the podcast, we're going to keep it pretty fluid and see how we get on. On a small programming note, let me just mention that we are having some technical issues with Rich's connection, so he may not last the full conversation, but we will try to get as much from Rich as we can. And since it's polite to let the ladies go first, why don't you, Katie, share your first topic and feel free to direct it to anyone you would like to comment on it. And of course, afterwards, if anyone else has something to say, a strong view, feel free to jump in.
Well, I thought starting off that we should start by talking about what happened in 2023 and some of the things that have been sort of a theme this year. I myself have been writing my year-end review of sort of what went on this year and sort of trying to reflect upon what has been what I call a period of turbulence and some consolidation for trend following strategies. It really felt, so I was looking at these themes and there was a couple things that we noted in our yearly note. And one of them was the impact of extreme events. The second is sort of the persistent increase in volatility in the fixed income market and the focus on the fixed income market. The third was also a focus on where drawdown recovery for strategies like trend and the impact of these extreme events and consolidation. So for me, it's really been about thinking about what themes drove returns and investor behavior this year. So I think all of us know it was a very interesting point is that if you take just 2 days in the year 2023, and that's those 2 really extreme days in March, you had 2 days that actually shift the index for SG Trend from positive to negative. Those were some of the most extreme days for managed futures that we've seen in my career and in those of us that have been in the field longer as well. A few years ago, we wrote a paper called Measuring Turbulence. And this is an interesting paper. It uses the Malhanobis distance to measure sort of how big a move is relative to time periods. And what is interesting is that what happened to us in March is some of the biggest events for managed future that we've seen historically. And so for us, I think for me, it was really the bottom of the short end of the curve. And I think what we've been looking for the rest of the year was, when are we going to see the bottom of the long end, or when are we going to see that pivot in the hiking cycle? And so we really saw two of those bottom type events. And I always remind investors that trend followers, we don't pick tops and bottoms, we follow the main part of the trend. And so a year like this year was really about hitting that change, finding the next trend and where sort of markets are moving next. So I think today a lot of people are going to talk about these themes and sort of what the next theme is. But for me, it was really about looking at what this year really meant to us. And it was really the consolidation of the fixed income trend, the extreme events and the impact of those, but also just another key point is trends actually did work. Yields did go up on average this year. And one other thing that we found in our sort of annual review, I like to study CTA style factors. And last year, and we'll talk about this later probably too, we studied a lot about bond bias and how everybody is so used to being long bonds. An interesting point in my yearly review was noting that our long bond bias factor is actually negative this year. So even if you had sort of taken that long bond bias and put it back in because you thought, I just want to go back to being long biased, it actually had a negative impact on trend. And the reason for this is that there were a lot of periods this year where the long bond trend worked very well. I mean, the short bond trend worked very well, particularly after March going into around September, October. So I think for me, this is a year of consolidation, a year of moving towards the next trend, following fixed income, seeing where the next phase of that trade goes. And I'm excited to hear what my fellow panelists have to think about that, because those are the three things that came up for me this year: extreme events, end of the bond trend, next phase of the hiking cycle, and a year of consolidation after one of the best years in trend that we've seen in many, many decades. So with that, I'd love to hear what some of my fellow panelists thought for their key themes for 2023, if they were kind of thinking the same.
Exactly. So, Katie, I'm going to just jump in here, and I'm going to try and direct it to at least two that I think would be interesting to comment on that from their perspective. And actually, I thought of Andrew and Jem, because obviously Andrew from the industry as a whole, and Jem from a kind of extreme vol kind of situation may be interesting. And then anyone else who has a strong view should also chime in. But and I don't know, Jem or Andrew, if anyone would start off, but I thought it was some interesting observations, Katie.
Yeah, I'll dive in. I think the bond, the inflation question and the bond story is the big picture question, right? And I think if you get that right, much like maybe you got it right for 30 years and the monetary policy, right, or 30, 40 years, the monetary policy driven decrease in interest rates, I think that one will be critical to broader multi-annual performance. My view broadly is that what we're getting here in terms of inflation, even though we're seeing a slowdown in demand and cyclical slowdowns, and the headline number is coming down, there's a lot of clues underneath the hood that structural inflation is still very strong. Services inflation, particularly the labor component, ex-real estate, is very, very strong and accelerating right now amidst what is otherwise a cyclical decline. Now, there's a lot of clues that say this is not the end for inflation. And I think it's very interesting that we're recording this the day after the Fed meeting, where Powell came out and basically put a mission accomplished banner on the tanker, when I think history has not judged other chairmen that have pivoted or, as quickly very well. The causes of the inflation, much like in the 1970s and other periods before, is a function of populism and rebalancing. I think that's a critical thing for people to understand. It's not just the fiscal that comes with that. It's the protectionism. It's the deglobalization that leads to competition. War globally, whether that's economic or actual hot wars, commodity scarcity, and other entities competing and guarding their resources. We saw this again in the 70s and other periods as well. That stuff has not ended. If anything, the underneath the hood, we're seeing more of that this year. You're just not seeing that in price. And it's being combated by the cyclical effects of, which are generally short term, of monetary policy and taking real REITs positive. So I think that's something to keep an eye on going forward. I think the early pivot there, in my view, will not be judged well by history, but that's my opinion. I'd love to hear other people's thoughts, but I'll dive into that one. And I think this next year will be, particularly going into an election here in the U.S. with more fiscal spending, a very interesting one to watch.
Yeah, I mean, that's much deeper, much more insightful than what I'll say. I've been calling this the year of the whipsaw, basically. And I think that to me, the observation has just been total and utter confidence month to month that the market is, 1 month pointing that we're going to have a taper in January, and then by February it's higher for longer, and then by March it's half the month was higher for longer, and then it's, oh my God, we're going to global banking crisis, we're going to have a recession by June. And I think what's underlying it is, and we'll talk about this more later, but basically the alpha generation, however you define it in the space, is when it's contrarian, right? And that every institutional investor out there, every wealth management portfolio is designed to move slowly. And sometimes there are these huge tankers pointing in a direction, and every now and then the world changes faster. And it takes them a long time to pivot and change. And I think, back to last fall, I started talking to people about the inflation trade in early 2021. And if I told half the people that I spoke to that I know with 100% certainty, God tapped me on the shoulder and he's told me that inflation is coming back, they still wouldn't have changed their portfolios. Because they can't, right? They have 10-year asset allocation assumptions. They change things very much at the margin. So for about 18 months, the whole inflation trade and being short rates was a contrarian trade. And that we've also called this the one trade market, because that trade plays out through every other market. By last fall, it was crowded. And so what you've seen since last fall are these incredibly sharp moves where every time there's a hint of the taper, people are rushing to reload on duration. And then it looks for higher for longer, and they dump it. So I think that's just underlying it, the behavior cultures that's driving the volatility, which is hard, particularly when you're a long-term trend follower and you feel like you bounce back and forth from propeller to propeller, which has certainly felt like the case this year.
I love this because our prognostication for 2024 fits with both of you. We expect higher volatility of inflation and growth next year, which is kind of in the same theme, that we're going to have a lot more undulations, similar to the fact that we've kind of moved to a new phase of that interest rate trade. So I think we're all kind of on board. What the cycles of those and how to trade those is going to be the challenge, but it definitely seems like you both have a similar view coming from different perspectives.
Great, super. Jim, why don't you bring up another topic that you've thought of this year?
Yeah, I guess I'd be remiss if I didn't lead in with a conversation about volatility. I think one of the biggest things that's happened broadly across markets is the acceleration in volumes in the options market, particularly zero DTE, and also the effect that I've kind of highlighted that is becoming much more prominent and important, and I think will play very importantly into the coming year, of structured product issuance. I think that in my world is the most important thing, and I think critical to not only trend but all investing right now. And very few people really have their thumb on this, and it's so critical. I'll start with what I think is the most important kind of structure element, which is the structured product issuance. Because of higher interest rates throughout the last several years, we've had and poor market performance broadly over the last 2 years, even though this year has been quite good, and concerns by investors. There has been a dramatic move towards investments that now yield 8.5% that are broadly selling vol, and that are stacking maybe a 2.5%, 3.5% yield on top of that risk-free 5.5%. These structured products take many different forms. I'm not going to go into all of them, but essentially are issued by banks and are very desirable. These are structured products that maybe yielded only 4.5% when interest rates were 4% lower. And now you're getting a significantly higher yield on those, And importantly, there's less appeal to investing in the equity market broadly for all the reasons we've kind of covered. And you look at the last 2 years of performance, obviously hasn't done very well, as opposed to the, call it 15 years before, where we saw on average 12% annual returns. So the value proposition to investors of a non-correlated higher yield has really moved dramatic increases in structured product issuance. What effect has that had? Why is that important? Because ultimately what that means is that dealers, the banks in particular, are taking on dramatic amounts of implied volatility. If customers are selling it to them and these banks are issuing it, they're taking on long volatility. And so this long volatility is then being pushed onto the market. So counterintuitively, historically, when interest rates have gone higher, historically people have moved to the bond market. You're getting some of that, but you're getting bond plus, which is generally structured products. These did not exist in the 1970s. This is ironically had a feedback loop that is dampening volatility at the core, at the center of markets, which is the index itself, which is where most of these structured products are issued. Not only has that driven, record, really low VIX. If you look at the chart of implied volatility, it's been a plane crash almost, right? That not only has it driven that, but it's driven a very important dynamic that other people aren't thinking about, which is dispersion. The vol supply is coming right into the middle. I think of it kind of like a donut of markets, right into the S&P and the indexes broadly. Meanwhile, interest rates, as they go higher, right, are increasing volatility on the edges and around broadly in the market. So you're getting rates volatility, like you've discussed. Others have discussed. You're getting other, FX volatility. You're getting precious metals volatility. You're getting commodity volatility. You're getting all these things because interest rates are going higher and liquidity broadly is decreasing. But as that happens and yields go higher, you're getting structured product issuance, which is providing massive supply to the middle of everything, which is driving a massive dispersion and difference between how index vol is performing in the equity land relative to everything else. And I think that's the biggest takeaway. Zero DTE has, because of that vol pitting on the index, has been a very desirable place to sell volatility. And after initially getting a lot of interest from people last year because realized volatility was outperforming implied. So from the long side, people were speculating kind of like they were in, YOLO calls and other ways, really directionally and trying to take advantage of realized vol. Now it's really turned to vol selling. And what zero DTE does is it allows people not to worry about this more complicated implied vol performance issue and just bet on the realized outcome. So that's what's really driven the appeal of zero DTE. Zero DTE has been made out to be this, that it's something that's going to destroy the world, that's going to blow up everything. I do think it has an incredible, dangerous function in the sense that it's a magnifier. Right now, that magnification is actually creating even more vol compression because of all the vol selling. But it's zero DTE, and that is so fickle. It can change in a day what that positioning is. If we were to get an event, that could very much turn the other way and become very much, making dealers short vol and making customers long, which itself it could be very vol accelerating as opposed to dampening. So it's an accelerant, and I think the massive amount of volume there is dangerous. There's not enough regulation that's caught up with it. There's not proper margining for zero DTE. This is 40% of the market now. Believe it or not, margining is done on a daily basis. So zero DTE options are actually not margined by regulatory authorities. It's insane. There's this issue, one, and two, there's the simple fact that zero DTE can only be hedged by zero DTE. If you go ask market makers how they're hedging it with the only thing that they can because the deltas move so quickly and there's nothing that has as much gamma or can be hedged in that way, which is creating a reflexive loop where if at one point instantaneously the markets get swept or there's a dramatic long vol trade because of an event, that can force everybody into a cascade and can be very dangerous as well. So I think those are the things I'd highlight around vol and the current market, all very interesting, different new things. I will give a little teaser here to predictions going forward. What happens when interest rates come down to this trade, right? When this has happened, all of this structured vol supply, which is really the edge that is the core dampener here, has been there because interest rates are higher. And ironically, if interest rates go down, you're actually going to see the opposite coming. So I'll leave that for everybody to think about.
Now, I'm going to just call out a couple of names here, but I'm thinking we have only one who really works at a bank among us, and that's Nick. So, Nick, any thoughts on this topic?
I mean, where would I start? I mean, without necessarily claiming that I have the volatility expertise that Jem has, the one thing I would say is that zero DTs is certainly possibly the keyword that has been played out more than any other in the last year and a half. And obviously, we're observing the market in a variety of ways. We look at it specifically where I sit on the systematic investing side of the business as to how we can allow our investors and our clients to benefit from it, but obviously in a very careful manner. So, a few things that were mentioned, like I think where the danger lies that this is still a derivative, right? So that gives you magnification. I think that was precisely well put by Jem. And the way we look at it is, first we do some sort of analysis on net demand and net supply of those, and we typically look into a grid between maturities and the deltas, right? So the further out you go out of the at the money region, the more demand you have had from the market. And that can be easily understood because on the one hand, on the kind of the out of the money call options, these are like lottery tickets, right? You come in the morning, you get the call option. If the market skyrockets for whatever reason, you basically get a gain at extremely little cost. On the opposite front, you have the so-called crash puts. And this can also be utilized by broker-dealers to hedge their gap risk, right? So here you have some sort of natural demand which serves specific purposes which are different to just systematically harvesting a particular premium, which obviously makes those much more richer, and therefore that's a natural place to do selling, right? So one of the things we're trying to operate on is identifying possibilities of creating a yield enhancing profile, effectively selling those options, harvesting the implied realized, but doing so obviously in a very careful manner. We have seen this grid that I kind of mentioned, maturity and strike shifting in the recent years. The classical weekly/monthly space that investors have been selling volatility has been now shifting into those shorter dated, more out of the money options. It is a place that we're very carefully monitoring. I'll possibly leave it at that point before it becomes a bit more contentious. But this is certainly a keyword for the days.
Okay. Anyone else? Mark?
No, I wanted to ask you the question because I put this all under the broad topic of market structural change. So we've got a change because of zero DTE. We've got a change because of the flows that are going into structured products. So as systematic investors, we're constantly trying to say is like, well, how do I adjust my models because of this? What is going to be different? And is it systemic and repeatable, so it's going to last for a while, or is it not going to last? So I'd ask the question is that given all of this information and flows, how do you adjust a model to account for this? Or don't you?
Rob,
it's interesting, but if let's say I got lower vol in equities, I could say, well, my models might take into account different vol regimes, so therefore I'm not worried about it. So is this an issue that can be modeled, and how would you handle this market structure?
Rob, you've written more books than anyone else put together. So how do you deal with this?
Yeah, I don't know. It's a long time since I traded vol. I haven't traded vol for.
But it could have an impact on other model. I think on other markets. I think that's what Mark is. Us as model traders, so to speak. Do we need to take into account for these type of changes, or do we just put it and say, well, this will be just an anomaly for a period of time, and then it goes back to normal?
I mean, I guess it depends on your time scale. So obviously, the sort of stuff that the guys have talked about is very short dated gamma, right? So intraday volatility dynamics and trend dynamics would probably be quite heavily affected. I guess for the sort of time scale that most of us trade at the margin, all that's going to do is sort of have probably a quite smallish effect on our kind of volatility estimate. Because, if you're using, say, about a month's worth of returns for vol, which is roughly what most people do in a kind of hand-waving way, then, you're talking about 1 day of that, which is like, 4% being affected by potentially some weird vol dynamics at the margin because of this stuff. So, I'm quite relaxed, to be honest. I guess you should probably stay away from things like executing trades around the period when these things are being hedged or when they're about to close. because that could cause some potential, big gaps and stuff. But again, you probably would be sensible and not do that regardless of the vol environment. So yeah, I mean, I just remember trading vol 20 years ago and being short gamma with an hour before expiry, and again, it seems bizarre to me that people would voluntarily put themselves in that position, but we live in crazy times, right?
Let's jump on to the next topic, Alan. Very curious to hear what you brought along.
Good stuff. Shifting gears a bit, and I suppose back to a topic I've come back to a few times before, and I know it's a favorite of yours, Niels, as well, around trend and non-trend strategies. So the question is around the value of non-trend strategies. Very often you hear from managers, particularly trend followers, who'll say, non-trend doesn't really add a lot of value. It's really just for smoothing returns. So first of all, is that true? Does non-trend really just smooth returns in a diversified managed futures portfolio? And secondly, if that was actually true, is that not a good thing in itself? So what's the value of smoother returns? And I suppose I'm thinking of this from the perspective of, if I think of the types of investors I've worked with, you get different categories of investors. Some are more the long-term kind of family office type investors who are very much shooting for the absolute returns and the highest compound average annual growth rate. But often you have a lot of people who have career risk and work in private banks or wealth management firms and multi-asset portfolios, etc. They have to report to an investment committee or a board. So smooth returns are actually, in my opinion, quite valuable for these people. So so those two questions, and I suppose firstly from the perspective of trend and non-trend, can non-trend work? Just to give a little bit more context, we had a research paper from CFM going back a few years where they highlighted that if you look at the returns from the SocGen CTA index and applied a simple trend, 6-month moving average model, it explained the majority of the returns of the index. So their conclusion was CTAs weren't very good at non-trend. So I guess maybe an ancillary question to this is it not whether non-trend doesn't work, but maybe CTAs aren't particularly good at doing non-trend in aggregate. So probably 3 questions there in total. Very curious, probably to get Rich's view on this, because I've definitely heard Rich talking about trend and that kind of compounding over time, and probably Rob and maybe Mark as well.
All right, Rich. I think as someone who embrace trend to a, let's call it a healthy extreme, what do you have to say?
Yeah, well, it was a great question by Alan. And look, I think we all accept the fact that if we get an uncorrelated mix of strategies together, the natural result is to smooth the overall return profile of the portfolio once we bring them all together. But my question coming back to this would be, are we just contributing to smoothness, or are we actually contributing to lifting power, what I'm calling lifting power of the portfolio? So one of the concerns I've got with the integration of non-trend into trend is that we accept that trend is already very globally diversified. When you're therefore allocating into non-trend, my counter argument to this would be, are we making the portfolio possibly less diversified than it is under a globally diversified trend treatment? The other question I'd raise is, what are the new risks we are incorporating into the portfolio with non-trend, and how is that contributing overall to the portfolio? Is it increasing negative skew opportunities into the portfolio? Is it bringing new risk into the portfolio? We all know about the LTCM, blow up. We recognise that was under a concession, an extended history of what we call incredible smoothness, magnificent Sharpe ratio. There was this hidden risk embedded within LTCM, which, under negative skew and a crisis event, cascaded out of that great result into what it actually became. So, are we potentially, by incorporating non-trend into trend, are we, for a start, can we go further in trend to achieve all of these outcomes, like a smoother portfolio plus the lifting power in trend alone. I tend to think that more effort needs to be placed on system diversification in trend. Market diversification is very well known in trend, but I think that more effort in trend alone could be put into systemic diversification, because I do think that we get the best of all worlds in trend, in that by cutting losses short, letting profits run, we're already embedding a sort of a positive skew asymmetry into the portfolio process. I think that's very helpful. One of the problems we've got to face is that typically performance returns tend to cluster. And with greater diversification, particularly in system diversification, I think that we can spread the impacts of this non-linearity, or the non-linearity, the outliers which are driving a lot of our performance. I think we can spread that better across the time series, as opposed to it being necessarily clustered. So there's some of the things I'd say. I love the question from Alan, but of course, being 100% trend following as I am, what is this non-trend we speak of?
All right, well, let's jump to someone who actually does a bit of both, I guess. Rob, you embrace both camps.
Yeah, I'm the famously impure trend follower, as everyone knows. Trend follower plus everything, that's me. Obviously, those criticisms are all interesting. Generally speaking, if you add non-trend, you're going to push up your Sharpe ratio, but obviously other things in your distribution will change. So you will get less negative skew, less positive skew, but you won't necessarily get negative skew. So, this is kind of a straw man here that, you've got a choice between either running LTCM or pure trend. There's an awful lot in between those two extremes. You can quite easily add a fair bit of non-trend to your portfolio, such that, the Sharpe gets bumped up by quite a lot and the skew does reduce, but not massively. And you still end up with something that's, we've got a pretty solid positive skew behind it. I do think that the area of diversification is an interesting one, because it's definitely true that the diversification within trend following as a strategy is very high. So you get a very big uplift from trading one instrument to trading 100 instruments in trend following. And that's a bigger uplift than you get in, say, a non-trend strategy like carry. Whether that means that the kind of combined strategy has less diversification within it, I'm not kind of convinced. I think you need to actually test that empirically. I've never actually done that work, so I've got some homework to do now before I come back to you on that point, I think. So that, maybe somebody else has done that work and can comment on that, but that I haven't checked. But my gut feeling is that actually, a combined strategy trend and non-trend trend would still be very diversified, because it would still have all the original diversification of the trend strategy plus the diversification of the non-trend strategy and so on. I think the kind of point about, we can do all this with trend, is true to an extent, but there are diminishing returns, right? So if you go from trading, trend, a single trend strategy on a single market, you can improve that a hell of a lot by adding additional markets up to a point. You obviously get diminishing returns beyond a certain number, and we can argue about whether it's 50 markets, 100 markets, 250 markets, but at some point, that kind of improvement is going to be leveling off and you're going to struggle to get much more. The same thing happens if you diversify across different kinds of trend strategies. So if you go from just using a single trend strategy using different variations on a theme, again, you can get an improvement, but that levels off, and that levels off very quickly. So, there aren't that many orthogonal ways of picking up trend out there is what I would say. So I do think you reach this kind of point where you can't improve the kind of, let's say, the joint characteristics of the portfolio, by which I mean some hand-waving combination of, Sharpe and skew, say. You can't improve the joint characteristics of the portfolio that much by just sticking in trend. Adding in some non-trend does improve that quite a lot. Although obviously, as I said, it does sort of shift gears slightly away from being, very positive skew, not great Sharpe, to being quite a bit better Sharpe and a little bit less positive skew. And then, as I said, as long as you don't go crazy and kind of keep pulling that lever and then have LTCM, I think you've still got a portfolio that's kind of got some nice trend-like properties, but has got a lot more kind of internal sort of style diversification within it.
I was going to ask the question is that, yes, when you talk about smoothing, who should do the smoothing? So you could do the smoothing at the hedge fund level, or you could say that's the smoothing should be done at the investor level. so that he has a better idea of how much smoothing he wants. So that's one question. Then the second is that is smoothing for a trend follower, is that a business decision? So if you smooth, then you can reduce drawdowns, and so you could sort of, live another day to continue on your strategy. And then the third question is that if we do add smoothing or non-trend characteristics, can a trend follower have a comparative advantage at doing that? So can someone who's a systematic trend follower, does he have skill sets that could actually then be transferred to non-trend type of modeling? So because we're all systematic modelers, so you're just doing a count. You're counting different events, and you're trying to look for repetition. So is that a skill that's transferable, and it just happens that we do it on trend? So I'll throw those out as some questions.
I know other people want to join in, and I'll just say very quickly that it's quite true to say on the first 2 points that the kind of incentive structure for me as an individual trader who, is doing what I'm doing is going to be different from someone who's offering a product out. If you're offering out a product and you're offering out a product to institutional investors who want to buy trend following, then clearly you want to give them trend following, right? So, I'll shut up now because I think the people working in institutions can answer these questions better than I can.
Yeah, just real quick. I think this is, again, I got to sound off here from the vol side. I mean, the question ends up being, what is trend, right? The trend, again, I'm not going to try and tell you guys what trend is, right? But from my opinion, it's a two-dimensional expression, right, of market movement, which is asset-based. Options themselves add the non-linearity and the ability to express some of these things from the beginning, right? The stops, the move in trend, the speed of the move, all of these things. I think there is an ability to express, and I agree that the expertise that comes from this quantitative modeling on this side can be put back into and expressed in volatility terms. And we brought it up before, the introduction and increase of using options. How can that affect trend? I would just throw this in here. That non-linearity that's being put in the market should be expressed with more non-linearity itself. So maybe there's a place out there to do trend, but with more non-linear expression through options as a way to express that.
I'll just make one comment. I tend to be a little more pluralistic. I think that people have different objective functions and different goals. And that kind of goes with what Mark says, is that trend is a very divergent strategy, as Mark would also probably say. And these other strategies are more convergent. And so it's going to depend on what is the objective of an individual investor. And some investors have different constraints related to being able to hold something, being able to explain it to their board. And then others are really saying, I want something that has the biggest convexity, that has the best complementarity to my overall portfolio as a whole. And I'm trying to optimize my overall Sharpe ratio. So I think there's room for all of those options for depending on what the actual investor's objective function is. So I think we all kind of probably agree with that, but that means that there's room for all of these approaches for across the space.
Yeah, I'll jump to Nick and then Andrew.
I'll be super quick because I think we have discussed a number of good points. The only one thing I would say is the following. Adding a number of strategies together or profiles, we have to be extremely careful not cannibalizing what we already do, right? And when I think about Curie, and I completely agree with Katie, these are more like divergent strategies versus convergent and how we put the two together. In an environment that I'm buying bonds because the curves are upward sloping and I have positive momentum, then happy days, or possibly I'm concentrating too much risk to go back to some of the points that Rob made. At the times that curves are inverted, but for whatever reason, prices have not yet followed through, I'm now cannibalizing my long exposure with my short exposure, and the whole lot just doesn't really make any sense, right? In other words, people say, how about reversion in trend? I'm like, okay, if I do anti-trend, I'm going to add the two together, I'm going to get a zero. So I think what is extremely careful is that trying to add more profiles, I think we should keep in mind what are the principal components we're achieving, and then try to the extent possible, minimize those exposures so that the addition of a new theme is purely additive, at least from a performance and Sharpe ratio perspective.
Yeah, so first I completely agree with what Katie said. First, a lot of it depends on whether people stare at line items or they look at the whole portfolio. And one of the, just from a observation of this space, when we got into the space in 2015, non-trend was cool. right? This was the period of time where people were afraid of the commoditization of trends through bank swap products and other things, and there was this idea that there was a high alpha that added component of the space, and then there was kind of something that was becoming somewhat more commoditized. That all changed in March of 2020. Trend did better, much to people's surprise, and so and then it did better in 2020, and it did better in 2021, and it did better in 2020. It knocked the lights out in 2022. This year, it's doing worse. So the really interesting thing is going to be, is this the investor bias? Do they look at long-term trend, which has gone through a rough whipsaw recently, relative to, and do they frame it in the context of the preceding years, or do you have this kind of pivot back to non-trend because it's worked better this year? That's an open question. We shall see.
Okay, great stuff. All right, let's pivot, so to speak. And Nick, what have you brought along for us?
So I think that's going to be interesting, because what I want to point out to is that I think Katie already and Alan used the term SocGen trend. And for all of us here, and most likely for the vast majority of our listeners, SocGen trend has been quote unquote the benchmark. And I'm going to explain myself why I say quote unquote. And this comes from the so-called New Age trend index. A futures broker back in the days acquired by SocGen, and then they continue kind of rolling out that index, which in itself is the largest 20 CTAs or the largest 10 trend following CTAs. There are two variations of it, pretty similar in a way, because the vast majority of CTAs are doing trend following. Anyhow, that's not the point here. The point being, this has been the benchmark that every one of us has been monitoring as the proxy of the industry, and as of about a month or so ago, it is no longer available in Bloomberg, at least quote unquote for free. So it's become now available under a license, and that has obviously brought a number of questions with ourselves and our clients and so on. What's going on now with this benchmark? Unless we are able to look at it in a free manner, how we're going to operate from this point onwards. It might be a small thing or not just a small thing, and by all means, I'm not going to make any comment with regards to a business decision, I would imagine, by the issuer, but it has raised a question. And what are we now using to compare our returns against? And obviously, some of our clients said, should we use the BMF? So I'm going to ask Andrew later on what he thinks about this one. Let me tell you my views, right? So I think in the CTA space and in the active management world, benchmarks themselves are very hard to define, because even the constituents themselves are living creatures, right? So the models we run today, or all of you guys are running today, are not the models you were running back then. So even building a portfolio today with new ideas as to how we build a trend strategy or whatever strategy, and comparing ourselves against the trend industry performance in 2015, it's an unfair comparison, right? Because it's now a different model. We're not just building a rule today that we backtest as a rule and then we try to understand how better or worse we've done. We're now backtesting ourselves against a universe of managers that haven't seen COVID, that haven't seen rate shocks of 6 and 7 and 8 sigmas. So to me, benchmark in this space is very hard to be defined. And I'm going back to the point I made on quote unquote a benchmark. That's the first thing. The other thing, however, which is critical for our discussion, is that human beings, let alone investors, they need comparables, right? Somehow it's our human nature to look for something that we compare ourselves against. We outperform, we're better, we're worse. We try to make better, we try to get there. So I don't think the fact that SocGen Trend Index is no longer available, at least in the form that it used to be, is going to negate the need for a benchmark. Whether that was a good or a bad, that's another discussion. So here's my question to the group. What's going to happen with the benchmark?
Well, I think you're absolutely right, Nick, in saying that it will be interesting to hear Andrew's thoughts, because I guess, Andrew, although you may not be tracking the trend index, you are kind of relying on getting data on an index in order to replicate it. So what are your thoughts? And what if they take this SocGen CTA index and do the same? Are there other ways of getting the data?
So first thing, Nick, I completely agree with all your points. I mean, one of the huge issues with this space is if you're, again, you think about the typical allocator who's building long-term capital markets assumptions. SocGen CTA index starts in 2000. And so, you will see people who will run numbers back to the 1980s, but the farther and farther back you go, the more made up they are. Because somebody in 2000 decided that there was some guy in 1985, who happens to have been alive 15 years later, who they pretend they would have invested in on an equally weighted basis. The index issue is something that's not just, if you think about like the S&P 500, the S&P 500 is a living organism as well. And the nature of the firms that are inside of it change over time. And that was Buffett's point, right? When you're investing in the S&P 500, you have dynamic companies, you have dynamic changes, you have it's following, changing over time. This industry needs a better benchmark. The SocGen CTA index itself was inherently flawed in a lot of ways in that it was never really accessible. It's really accessible to everybody here because you guys are industry practitioners, but what the industry needs is an investable version where you can say, it needs an SPY where you can say, here's my easy way of getting exposure to the space. It's not going to be perfect. It's going to be broad-based exposure. But wow, look at what this guy's doing over here. We think he does much better, and we think he's going to do much better over time. Therefore, we're going to use him as it. So I think this is something that's going to evolve a lot over time. There is a circularity in it whenever you're talking about a hedge fund benchmark in that you can't invest in it. Right? You can't invest in it. So you can look at the SocGen CTA index, but you can't actually invest in it unless you're Adia or somebody and you want to invest across the fund. So it's a huge issue. I am working on it, guys, and we'll hopefully you'll hear more about it in the next several months.
Okay, cool. So just maybe if I may jump in myself and just comment on one thing, Nick, in that regard. I remember I was at a conference, and I think actually it was the EQD conference where I met you in January of last year, or this year, Nick. And I went to a lunch hosted by SocGen where they talked about the SocGen Trend Index and how they were building a model to replicate it. So they clearly was inspired by Andrew to replicate CTAs. And I think they mentioned during that lunch that they were going to launch that as an investable index. And I also noticed that on the website of SocGen, when you download the data now for the trend index and the other indices, it first of all has a very short look back now. It only goes back like a year. And it talks about a net asset value. It doesn't talk about, whatever 1,000 has come into. So I wonder if what you're seeing on Bloomberg has something to do with the fact that they either have launched it or are about to launch the trend index as an investable index, where they do a replication of that index and not the index that Andrew is replicating. So that would be not my outrageous prediction for 2024. We'll come to that in the second half, but I'm just throwing it out there. Andrew?
I would add one thing. So one of the when in our world, the key thing is you need daily data, right? And fortunately, this is an area where there's a lot of daily data. So you can, and a guy named Corey Hofstein in the U.S., as soon as they announced this, basically showed you take 10 mutual funds that have some trend somewhere in the first sentence of their prospectus, and you combine them together, and you get something that is a 98% correlation to the SocGen CTA trend subindex. So I think this is, but I think this is a critical issue that the industry needs to solve, because we're dealing with people. The questions that Nick is asking in terms of the integrity of the index, the accuracy of it, 99% of people just want something they can point to, and they can say, this is what we're plugging into models, this is what it's done over X period of time, and make some inference, some theatrical inference as to what they think the correlation, risk return, Sharpe ratio, and everything else of the strategy is going to be over time. And this industry, in part, just really hasn't had it. And I think that's, if we solve that, I think actually you can start to really expand the pie.
Before we jump on to the next topic, I wanted to maybe ask you, Jem, in terms of vol indices and tracking what the industry for vol managers are doing, I imagine that it's even worse than it is in our industry, but maybe you can enlighten me here.
Yeah, that the whole multidimensionality part kind of creates lots of problems. When you say vol manager, even if you say long vol, short vol, those are, there is no really one long vol or one short vol, right? You can be long a 1 delta put 2 weeks out or long a straddle a year out. Those things are all long vol. They have almost no relationship to one another except on the far tail. And to look at performance month over month for something that is a tail, strategy in that regard is almost impossible. Never mind the shortfall, relative value pieces. It is, as I like to say, vol is not an asset class, right? Vol is the underlying distribution that underlies all assets. And I think trying to look at it as a separate asset class is a problem to begin with.
Okay, that's a fair point. All right, well, the next in line to bring up an insightful topic is you, Rob.
So there's a whole set of issues then about kind of what we call ourselves, how we describe ourselves, how we classify ourselves, and it's hilarious that we can't get our act together with respect to the outside world, but we've got this kind of infighting between people calling themselves classic, people calling themselves other things. So it's kind of amusing. I mean, I find it difficult enough to explain to my mother what I do for a living without having to explain to her that actually there are these other people who are called classic trend followers. I'm not one of them. And I'm not, by the way, I wouldn't call myself a quant trader because I'm not high frequency, so not really a question there, but a kind of kickoff for a discussion, I suppose.
I think that's fair. And since we have one of the people who are being called out, at least, I'm not sure whether he's doing it himself, but I know others are calling him out, including him in the group of apparently only 5 in the world now. There's only 5 classic trend followers in the world left. Luckily, we have one of them here today, and that's you, Rich.
Well, thank you very much. Thank you very much. Now, listen, you've all got a chance to come over to our side, but look, I think it's important to distinguish ourselves as trend followers. I tend to sit in Harold de Beer's camp in that I don't want to be considered to be doing exactly the same thing as everyone else in trend following land. So in relation to why we position ourselves as classic, we do want to differentiate ourselves from trend followers who are what we would be considering adding non-trend into their portfolios. We want to sort of recall the golden days of trend following of the 80s and 90s, where these very simple models with no complex overlays were being adopted by the trend followers. We like to think that is actually a strength as opposed to a traditional old style weakness. So yeah, look, I'm very much in the camp of the need to distinguish what we do from what others do. I suppose, already we've got this difference in opinion regarding what is trend for a start. We see that across the investment world, across the trading world. Some people consider it components of sort of cross-sectional momentum. Others think of it as components of absolute momentum. Others are thinking that trends might be, segments of a mean reverting cycle. Others think that trends might be components of the tail region, which they refer to as outliers. So there are all of these different opinions on what is trend. This classic style we're talking about is a style of model that when they look at their histogram is looking at 5 to 10% of their trades being the things that contribute to their overall profits. They accept that 90% of their trades, which were targeting trends when those trades were being implemented because the models were applying a rigorous, process from the backtest, those 90% were effectively not outliers. They were not the things contributing to the overall success of our program. So I think it's important when we're talking with investors, when we're talking with allocators, that we can clearly say what we do so that they can appreciate what's under the hood of our programs rather than a generic sort of, we're trend followers, but got a bit of trend, non-trend in there, got a bit of pattern recognition, got a bit of this, got a bit of that, all of those components in there, because I think that fuzziness doesn't really help the allocator, doesn't really help the consumer. Rob, I'm sorry you might not meet the classic definition, but look, with a bit of practice next year, I'm sure you'll be able to get there, mate.
Good stuff. All right. Actually, I'd love to hear your thoughts, Katie, on this, since you're also deeply rooted in the trend following space. Whether you would define yourself as classic or not, I'm excited to find out.
Oh, that's a good question. I mean, my general view with trend following is that what's so interesting about the strategy is really following an approach that adjusts to changing market moves. And so the reason why trend works very well is that it's not really about adding your overlay of sort of what you think should happen. It's really about following what is happening in the markets. And so from my perspective, it's really that philosophical approach, which makes you a pure trend follower, where you're letting the data tell you what's happening. So that really is a distinction for me between a pure trend follower and non, is that somebody who says, where are the markets going? Let's follow them. You could divide it into classic, non-classic. I mean, for me, it's really that philosophical approach that you are moving with markets as they change. And that's where that diversification comes in the moments of the biggest stress, because it's so hard to make a decision and to actually prognosticate about how do I enter this trade? What should I do in those moments? And that's where that diversification from trend following comes from, just that philosophical view that I'm going to follow the markets. So I think that's, for me, it's more about a philosophical distinction. I do think that there is value to adding other approaches into trend if you have a different objective function, but and, it's something I do as well. So maybe I'm not pure trend, but if I'm honest with myself, I think the fascinating part about being a trend follower is that dedication to the process and sort of this idea of measuring what the market is telling you and sort of letting the market help you to kind of follow the prevailing themes with a systematic approach.
Well, you certainly don't disappoint me, Katie, because you're always very inclusive. And of course, by that definition, we're all included in this. But anyways, I'm sure it's a topic that we'll also cover in next year.
But Neil, I was going to ask the question is that we still wanted to get to, if I always like to have, like, for hedge fund strategies or any kind of investment strategies, you always kind of think of like a taxonomy, that there's we do it in the animal kingdom, we do it in the plant kingdom. So if we had to do it in the strategy kingdom, so I think, like, for example, we're all systematics. Okay, so that could be top. We're all disciplined. Okay, that's next. Then you say, well, there's some that are more market directional. Then there's those that are market neutral. Then there's those that are short-term, long-term. Then there's, could sort of say, like, well, the style of how you do it. So I always sort of like classify it according to style, the time frame, and the markets traded. But if we had that would we be better off as an industry if we had a taxonomy so that people could then actually be able to view what we do and who we are? And I think the answer is yes, but I'd be interested in what other people think.
Sure, Rob, what do you thought?
Yeah, absolutely agree. And I think one thing that shouldn't be in this taxonomy necessarily or that high up is the, kind of the asset class register you're trading. That's what's the least important thing, I think, to an extent. And maybe there's distinction in vol and non-vol, but, does it really matter, for example, if I get my equity exposure through buying, a bunch of individual equities or indices, to a kind of first order approximation? Not so much. I mean, does it matter whether I take my positions through futures or CFDs? That's even less important. But one of the things about the kind of name of what we do, which is, managed futures, is it puts the kind of, the type of thing you're trading right up there. And I think in terms of allocators, a lot of people still, one of the first boxes they must want to put you in is the asset class box. And as a strategy that grows across asset classes, that's always going to make things a bit more awkward. I think for me, the asset class is almost should be right at the bottom of this taxonomy. Like, I'm going to have more in common with somebody who's sort of doing what I do, but trading individual equities than someone who's trading futures, but in a completely different way.
Okay. Well, I mean, something I'm going to come to you in a second, Andrew. But by giving that response, Rob, you've actually clarified something for me, because we know that one of our very good friends to the show, of course, he talks about mismanaged futures and how he's not part of the managed futures industry anymore. But of course, by your definition, he wouldn't be, because he trades individual stocks, not futures. Maybe that's...
But he's still part of the big trend following family.
He's part of the Katie family. Yeah, that's true.
Yeah. Like Katie, I believe in inclusivity. And I think, these silly debates about, whether you're doing one thing slightly different from somebody else. But if you actually look at the output, returns that come out, they're not going to be that different. So
I love this man, by the way. I just thought I'd better say that.
Andrew, you had a thought?
Well, I think so. My thoughts are twofold. So one is that asset classes change their names and to something that has a positive connotation, right? So junk bonds became high yield bonds, right? Leveraged buyout sounded really scary. It became private equity. Asset-based lending became private credit. So most allocators just need a simple construct or a name, right? And if they like it, they don't ask a lot of subsequent questions. My experience is you say manage futures, and then a lot of people that I'm talking to don't know what a futures contract is. But it sounds incredibly scary. And you say something managed, there's no positive connotation to it. Trend following, I think, was designed to be everybody in this call believes that trend following is a good idea. I was surprised when I went to talk to people that a lot of people associate themselves with being the guy who gets it at the wrong time. Because I used to use the story of Eddie Murphy and Dan Aykroyd and Trading Places, and I'm thinking like they're going to think like they're going to identify with those guys, and the crowd is foolishly driving around prices to make the money. They associate with the crowd. So what I'm trying to do is base what all of these strategies, whatever they are, they're all opportunistic and it's all trading. And if you try to like get it down, and I think when you think about something that's called opportunistic, that's positive, right? It's not unopportunistic. So opportunistic and it's trading. And the reason I've put it in that context is going back to this point about where I think the alpha generation from the space is not 8 other people on this call beating each other up and extracting money from one guy or the other. It's not a zero-sum game. It's the 8 people on this call with trillions, tens of trillions of dollars that's designed to move slowly, that has an ethos about mean reversion, not mean aversion. So the label for the space, the common thing that picks up trend, non-trend, carry, et cetera, everything else, is basically a way for this space to generate excess returns over time that's complementary to what the rest of things that people have in their portfolio, and that it's conveyed in a positive way where somebody hears it and they say like, oh, that sounds great. I want that.
That is it for part 1 of our 2023 year-end special. We will, as mentioned, bring you the second part next week, which will also include our outrageous predictions for 2024. We hope that you enjoyed this, and if you did, perhaps as your Christmas gift to us, you could take 5 minutes of your time and go to Apple Podcast, Spotify, Amazon, or wherever you listen to your podcast and leave us a rating and review. This will mean a lot to us. And while you're there, make sure you follow the podcast, as this also helps us grow the show. And if you want to receive my weekly newsletter, just head over to toptradersunplugged.com/TTU-news. From all of us at Top Traders Unplugged, thank you so much for listening. We look forward to being back with you next week for part 2 of this conversation. Until then, happy holidays and take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.